Hey everybody, it's Jack and welcome back to another portfolio update video. It is that time of the week again, and we just finished week number 17 of my WealthSimple challenge. If you're new to the channel and wondering what it is I'm doing, I'm currently building a $1,000 account, and the aim is to get it to $100,000 through saving every single week and investing it into the stock market and just documenting that process here for you all. So that is the big goal, and we are slowly working towards it every single week. So before we dive into my portfolio and all the stocks that I purchased or sold last week, let's first talk about the stock market last week in the week that was. So we saw the stock market start to smooth out, and we've definitely seen less volatility than we were seeing a few weeks ago. So definitely a little less craziness. And we actually saw a decent week for the stock market in broad terms last week. We saw both the Canadian and US stock markets on average go up around 1% throughout the week. So that's really positive, and we're starting to move in that upwards direction, which is great to see. We also had a pretty significant week because it was kind of all the Canadian banks had their earnings come out, or at least the majority of them last week. So I'll definitely talk about that later in this video and how that plays into some of my stocks, as well as some that I might consider adding in the future. But hopping right into my account status and where my portfolio currently sits at, it currently sits at $5,522.10. On Friday, it was down $25.44 or 0.46%. And for the actual week, we had a really strong week, being up around 0.81%. So just under 1%, so up $44.42. And then for all time, we're actually currently break even. So we were actually down $8.10, 0.15%. So kind of exactly where we actually started, and we'll get into why that is and what stocks are kind of holding down the account. So quickly, before we dive into my actual stock positions, let me first talk about my kind of general strategy moving forward and how it's kind of evolved over the past month. So over the past month, I've really cut back how much I've been adding to my kind of higher risk growth stocks as we started to see a rise in inflation, and I think interest rates will also start to creep up. Those companies that are in the really small early growth stage usually leverage a lot of debt in order to grow the business, which is totally normal. But with interest rates potentially rising, that leveraging that debt and paying back that debt becomes substantially harder. So for that reason, I'm starting to cut back and not add as aggressively to some of those higher risk growth stocks, especially if we start to see kind of a more broad market pullback or even a crash over the next few months to a year. I'm not saying we will, but if that happens with the rise in inflation and interest rates, then I definitely want to be more focused. And which I've been doing is adding heavily to those dividend growth stocks in my position, because at least if things are to go south for a little while, at least with those dividend stocks, you're going to continue to collect those dividends and that passive income while you wait things out, and they will eventually, everything starts to correct itself and go back up, but you're still collecting those dividends in the meantime. Which, so really focusing on the well-established solid companies fundamentally that have been really paying those dividends for 20 plus years and have a track record of growing those dividends consistently every single year for the last little while. So that way, not only are you collecting those dividends, but every year as you hold those positions for a long time, my time horizon is 20, 30, 40 years down the road. So really being able to have those dividends that grow every single year, so that next year you're collecting more passive income and more and more and more, just helps to grow that snowball over time so that you can one day retire off of those dividends, which is the end goal. So taking a look at my spreadsheet where I track my entire stock portfolio as well as the passive income I earn from my dividends. So first, let's go over the stocks that I bought and sold last week. So we have right at the top, Algonquin Power and Utilities. This is one that I've been picking up kind of one or two shares every single week for the last little while, as it's currently trading substantially below my average cost basis on the stock, as my average cost is around $20 per share, and it's currently trading around $18.50, so almost down 10%. This is a great dividend growth stock that has a 4.5% dividend at the current rate, but also increases that dividend around 10% every single year, as it just did a few weeks ago. It just increased the dividend 10%. So this is a no-brainer, and I think one of the best Canadian stocks in today's market at the current prices. It has a PE ratio between 10 and 11, so a super great stock. And then the second stock that I added to last week was TD Bank, ticker symbol TD. This is one of the Canadian big banks, and TD had their earnings report come out last week along with a lot of the Canadian banks, and they actually beat analyst estimates by quite a significant amount. So it's looking really promising for the big Canadian banks in today's market. And TD actually dropped down around 2% late in the week. So instead of picking up one share, which I had planned to do, I actually picked up 2 shares, as this is a great dividend growth stock and has been growing its dividend really well over the past, 10, 20 years. So this is a no-brainer to add to the portfolio. And I definitely recommend the Canadian banks to any new investor. And if you didn't see last week's video, I actually went over a chart that shows how the Canadian banks are actually currently under regulation to not increase their dividend payout because they want to have enough cash on hand throughout the pandemic if anything were to happen and go south to be able to pay out people. So because of this regulation, all the banks are currently sitting on huge cash piles, so that once this regulation is actually lifted, it's not going to be a shock when these banks, raise their dividend potentially 10 to 15%. So I want to make sure to capitalize on this and kind of stock up on these bank stocks right now. So I added 2 shares to TD Bank, bringing my percentage of my portfolio up to 6.3%. The third stock I added to last week was Manulife Financial. This is a fairly new position in my portfolio that I added 2 to 3 weeks ago, and I've slowly been chipping away at over the past few weeks, adding a share or two here and there. So I added one more share of Manulife Financial, as it's still down from my average cost basis, around 2%. So I added one more share, and this pays around a 4.5% dividend, so another great dividend stock. And then another stock I added to as well last week was SmartCentres Real Estate Investment Trust. This is the only real estate investment trust that I own in my portfolio, a REIT, and these are great because they pay out monthly dividends, so you get paid every single month just for holding this stock, and a quite significant amount. The current yield on SmartCentres is over 6% at 6.32%. And the next stock that I want to point out is Canadian National Railway, ticker symbol CNR. This is one that in last week's video I said I was going to pick up another share of, and unfortunately I was unable to pick up another share of CNR because it actually had a really strong week and went up to $136 from when it was sitting at around $125 to start the week. I wanted to buy in at around 125, but I kind of missed the boat and it went up. And I'm kind of going to wait for this one to come back down a little bit, as ideally I kind of want to buy, below $130 as the share price and really bring down my cost basis. But this is another really great dividend growth king here in Canada that raises dividend extremely well every single year. And then finally, the last stock that I added to last week was Greenlane Renewables. This is one of my higher growth stocks. I continuously pick up around 5 shares of Greenlane Renewables every single week, as long as it's still down around that $1.50, $1.60 range, as I'm quite down on the position currently, down around 20%. However, this is a renewable natural gas company that is really in its infancy, both as a company and as the kind of sector and industry that they're in, the renewable natural gas. So this is one that I'm really excited about, for holding 5 to 10 years down the road and really seeing its growth in the long term. And this is one that I wouldn't be surprised if it gets to that $3 price range in the next year or two, as the industry does start to grow, because this company has been growing its fundamentals and revenue extremely well over the past few quarters. So this is one I'm really excited about, and I think is at a great price today, around that $1.50, $1.60 range. So I continuously just keep dollar cost averaging into this one and picking up 5 shares like every single week. And finally, a stock that I actually sold a few shares of last week was again Standard Lithium, ticker symbol SLL. This is a lithium mining company that currently is not generating any cash flow, so they're not actually selling any lithium. They're still in the mining and extraction phase. But for me, I just kind of wanted to de-risk my portfolio, as Standard Lithium was my largest position for a really long time. And because, as I mentioned, as interest rates potentially rise due to inflation, companies that have a lot of debt, which Standard Lithium, isn't generating any cash currently, it's only piling on debt, they are going to have a much harder time paying off those debts. So right now I'm just kind of minimizing my risk by decreasing my position slightly. I sold 10 shares from 100 down to 90, and it currently makes up 6.2% of my portfolio. So still a sizable chunk, as I am super bullish on the lithium industry and Standard Lithium over the next few years, but just wanted to mitigate my risk a bit. Another stock that I might trim over the next few weeks is H2O Innovation, potentially selling off, 20 or 25 shares if it does get back up to that $2.60 range. As again, that's another stock that's really bringing down the portfolio and has been struggling as of late, down around 20% as well on that position. But now taking a look at my dividend tracking and how my passive income through my dividends has been growing as I continuously add more dividend shares to my portfolio, we can see that last week my dividend income for annually was $139, but now it currently sits at $149, so just under $150 every single year is what I'll be collecting currently in dividends. So we can see that we increased it $10 by adding a few shares of dividend stocks this past week, and we can also see that the monthly average has now gone up almost another dollar. So our new monthly average for passive income is around $12.45. That again, every single month we get that $12 and we buy more dividend stocks with it, so that the snowball starts to grow and it continuously grows on itself every single year. It's also worth pointing out that I've added a new kind of chart in here, a little bar chart, to track my monthly dividend income every single month and kind of see how it grows over time and how we start to collect more and more dividends as we continuously add to the positions. So just a nice visualization to kind of see it grow and see how I'm getting paid from my dividend stocks. So you can see that in March, early on when we started this challenge, we only got 63 cents in dividend income. So very measly 63 cents. But in April is a month that most of my dividend stocks actually pay out their dividends. So we got $8.94. And then for May, we actually only got paid out $1.80. And those were only because of our 2 monthly dividend stocks. So you can see that in March, we got paid 63 cents for those. But since we continuously added to the positions over the past few months, in May from those 2 stocks, it grew to $1.80. And this is just going to continue to grow. And that baseline for that lower threshold for what we get paid in dividend stocks will also just increase as those dividends start to come in and buy more shares. So this is a cool little bar chart that I'm going to be showing you every single week to see how it grows on a month-to-month basis. But jumping into the portfolio breakdown and being able to see the weighting of each position in my portfolio, we can really start to see how we're diversified. It's kind of all in that kind of 9 to 5% range, which I really enjoy. And we can see that AQN is my largest position at 9.1%. But it's worth pointing out that TD grew substantially over the past week from around 3% to 6.3% as I doubled the number of shares I had in TD Bank, really adding to those bank stocks, which are great dividend growth stocks, as it now makes up 6.3%. Jumping into the sector allocation, again, I'm starting to really enjoy the weightings that we're seeing by sector, as again, most of the sectors are kind of in that 5 to 10% range, which is nice to see as we boosted our positions in Manulife and TD, really bringing up the weighting of financials, which are some of the best Canadian dividend stocks out there. And now looking at asset allocation, we can see the breakdown between dividend, growth, and ETF. Growth stocks have gone down in weighting as I'm not adding as aggressively to them. So they sit at 23%. I'm probably going to get that down to around 20%. ETFs, I want to get above 20%. It's currently sitting at 19.3. So you'll see that in our weekly watch list, we're definitely going to be adding more to ETF positions over the coming weeks. And then dividend stocks sits in that sweet spot between 50 to 60% of the portfolio, as again, that's kind of the core strategy moving forward, dividend growth stocks. So that leads into the weekly watch list ahead. As I mentioned, I want to be adding to my ETF positions, and I'm actually going to be primarily focusing on my US exposure ETFs. So my NASDAQ 100 and S&P 500 ETFs, as these give me exposure to the US stock market. The Canadian stock market, I think, is one of the best places for dividend stocks. They really have some of the best dividend stocks across the financial, utilities, and telecom sectors here in Canada. But for growth, I really think the US is still ahead of us when it comes to growth stocks, as they have those big tech stocks and really just a lot more diversity when it comes to well-established large growth stocks. So for that reason, I have my NASDAQ 100 and S&P 500 ETF, which gives me great exposure to big tech and some of those other companies in the US that grow on a consistent basis. So those are my focus for my growth. And when it comes to dividends, because those 2 positions are quite expensive, the 2 ETFs, I won't have a lot of money left over to invest into dividend stocks. So I'm just going to focus on adding 1 or 2 shares of Smart Centers, and again, bringing up that monthly passive income through this monthly dividend stock. So there you have it. That's kind of my weekly watch list and where my portfolio currently stands. It's going to be a slightly kind of boring week for what I'm adding, as I'm going to be adding to my US exposure ETFs. So my NASDAQ 100 and S&P 500. Both of those are pretty expensive ETFs, both around $100. So doesn't leave a whole lot of wiggle room for me to add any more other positions, but I will also add to my Smart Centers position to just continue to increase that baseline of monthly passive income that I collect every single month, because Smart Centers is one of those monthly paying dividend stocks, which is awesome. But definitely let me know and everyone else know down below in the comments section what stock or what stocks you're going to be targeting this week and adding to your positions or starting new positions in. Let us all know down below so that, we can all learn from each other through this process. And remember, if you have been thinking about starting this own journey yourself, I definitely recommend opening a WealthSimple account. It's Canada's only $0 commission trading platform. And I'll leave a link down below in the description and comment section down below where you can sign up and start your own portfolio and journey alongside me. And you'll earn $10 free when you open that account. So definitely check that out. But I hope you guys enjoy this video, and smash that like button if you did. It means a lot, and subscribe to the channel. Lots more content coming your way.